welcome to the next section. Now we're just going to, for Dre here, go back and revisit number 5. Philip, on chart 5, could you actually just go through, by the way, we will actually be sending this out to you in a printed format, what the principles are, so, but I don't think it'll do any harm here to just go through it. Philip, from A to B through to F, please, if you could just go through the principles.
Of course I will, yes. A is a bottom reversal. What we've got is a down bar closing on the lows, the first bar. These are the 2 bars which are highlighted in yellow on the chart. The first bar is a down bar closing on the low. It's quite a wide spread, and it's after the falling prices behind us. The volume is quite high on that. The second bar is an up bar which is closed a little bit off the highs. A bottom reversal should really close ideally right towards the
So it is a
highs,
bottom reversal as the principle, but we're showing you a variation on one.
Slight variation.
Because there are variations on all of these.
But this is still a bottom reversal, and volume is quite similar on the up bar. Now, I mentioned before that if volume on the down bar is higher than volume on the up bar, that's always an advantage, unless the second bar, the up bar, has actually closed above the high of the down bar, the high of the first bar. Which
let me just repeat. I know exactly what you're saying. This bar here is closing. What we're saying is we'd like this bar closed in the body of that bar. We're saying we'd like to see this close higher than this bar here, which is the sort of tail of the bar or the top of the bar. Once it closes above that, now preferably the volume would be a little bit less.
A little bit, but if it's higher, that still shows strength because there's effort to go up.
Effort versus result. It's pushing up through there. And it's remember, this will be at a market bottom most often, yeah?
Yes.
And this sort of thing, if you ever see it in an uptrend, is even stronger.
Yes.
If you ever see that. You don't see it very often, but when you do, it's powerful. And then bar B, Philip?
And also, just mentioning on A, if the second bar, if the low pushes down lower than the low of the previous bar, that also is a sign of strength.
Right. Okay.
Because it's closing then right up towards the highs. Bar B, you've got a down bar which is back into the area of previous buying. You notice volume is pretty high on that bar. In fact, it's higher than the bottom reversal. It's closed right up in just above the middle, so there's clearly some buying in there again. Looking at bar C, that was a fall off in volume. You notice volume starting to decline there, which means the up move is starting to lose a little bit of momentum.
Yep.
Now when we get to bar D, remember the professionals have seen what's happened on bar C. They've seen that lack of interest, and they use that in order to sell into bar D. Now they're not selling entirely. Don't remember we've still got that strength in the background at A and B. That won't disappear, but there's some selling in bar D, and that's going to knock the market sideways for a while. Which
it actually did. And
it did.
Because now, what we're going to show you later on, just so you know, is this same principle that you're seeing here on Friday's chart, where it did actually break out through D and was a good move to the upside, yes. And we'll show you that, because Tom and I were watching that fairly closely.
Yeah, you need to remember, although there is some weakness at bar D and there's some selling there, the principles at A and B that we've seen won't disappear. That strength in the background is still there. So you just need to remember that. When we go across to bar E, we've got a down bar. Remember, there's supply on D, which is why the market's moved sideways. But when we get to E, we're falling there on very low volume. Yep. And that's a lovely example of a test.
And it's testing D, correct, Philip?
It's testing the bottom of bar D, isn't it?
Yep.
Yes.
So we're looking at the background again.
Yes. So always remember to look at the background, because the bars individually don't mean anything at all unless you relate them to what's in the background.
Absolutely.
It really is very important. I can't stress that enough.
Bar F is also a test, but this time it's on an up bar, but the body of the bar is not as high into the bar as the previous bar. So this is where Tom was talking. He really explained it well, I thought, yesterday or day before yesterday. We'll look a little bit later at a genuine no demand compared to what looks like a test. But here, Philip, you've got a test.
You have, yes. At bar F you've got another test, and we're beginning now, you notice, to develop an uptrend.
Yeah.
We have to be careful because we haven't taken the higher bar D out, so we've still got that supply above us, but there is certainly an uptrend developing.
Yeah. And we know that if this is genuinely bullish, if they keep testing this supply at C and D here, and it doesn't break that bar, the breakout to the upside becomes more and more of a probability the more they do it. And in fact, we'll show you something that we haven't shown before, which is multiple testing in a bull market, very strong, that it's going to break out to the upside. And actually, worth putting a buy order in above that previous area if it does break out. That's what happened on Friday.
Yes.
It's exactly what we saw.
And one other point, if I could just mention at the end of the chart, which is relevant, 3 bars from the end of the chart, you notice you've got what appears to be an upthrust.
Yes.
Now that's quite a high volume, well, it's a very high volume bar actually, and it's an up bar. And on its own, that bar looks like weakness. But we have to remember that we've got the strength in the background.
Mm-hmm.
Also, notice what happens to the next bar. The next bar is actually an up bar. Now, for that to have been true weakness, the next bar wouldn't have been up.
Correct.
It should have been down.
Yeah.
So it shows that there must have been some buying in that bar for the next bar to be up.
Yeah. Perfect. Now, Janet just said to me on number 4, where was the entry? It was at E. It was at E. And in fact, it was actually, that was the decision bar, and my buy order was just above this bar, or would have been above that bar there. Because, Janet, here, it's a nice low volume. It's a perfect example of a test. It's a narrow spread, close in the middle, volume very low. The lower the better. If it was that, it's even better. But this one responds positively to the test, and it's taken out my area A, if that's clear.
Yeah.
Okay, so that's quite important. And then that thing did explode. Okay, right, let's get to question 2. I'm attaching a chart, and you know who you are, who sent this in. It's a lady. It says, I'm attaching a chart of POT that I would like to... That's a great name for a stock, isn't it? Pot. You've got to go higher and higher with that one, surely.
That's quite a popular one, that one. I've seen that in
Very
quite a few
popular
seminars,
stock.
yes.
Oh dear, I could make some jokes on this one, but I won't. I have annotated the chart with my analysis. I'll look forward to hearing the thoughts of everyone on my analysis. My question, as I study charts nightly, which is great, revolve around testing of previous price action. Well, yes, we know that's a lot of people asking about tests. I look forward to hearing the experts discuss. Okay, so let's read this. You've got points A, B, C, D and E. I would like to discuss testing and what I see. First, the price action at A is tested with low volume bars at B. This would have been a nice place to set a contingent trade above these tests for a long trade. Price action at C is tested with the price action at D. I see this set up frequently at D on many stocks which when they test like this. Placing a long trade at the close of the low volume down bar in D with a stop below the low of the price action has been providing a nice trade. Price action at E is a quasi setup like D with the low volume test bar at the end of E. My question is on the length of time that instruments test. I know there is no set amount of time, but in looking at the price action on POT, it appears it's having difficulties breaking out of the action from A. Is this your read on this? As of today, I would wait for a breakdown or breakout above the high of price action A and wait for a no supply test back into this area. I would like to know if my analysis is headed in the right direction. Well, Philip, let's give you that one first of all, as you can see the chart there, because Tom won't be able to see all the detail. What's your thoughts?
Well, the simple answer is yes, but shall I give the long answer?
Give the long answer, because I think I agree. I think you're definitely grasping this. I think there's one thing that's apparent just looking at the... and I'll go to the bigger picture here first, because that's a daily chart. There is definitely a trading range appearing to be here that you're trying to trade in. And that's fine, there's nothing wrong with that. You can make money in a trading range. You have identified support correctly. I think you've identified the stopping volume, you've identified the test, so I can't see any issues with any of that. So Philip, let's go for the long answer with you then.
Right. Yeah, I would say that analysis is really spot on that chart. I think it's excellent. If we look at the bar A, which is the very high volume down bar, it's actually...
This one
the
here.
lady has highlighted two red bars in there, hasn't she, with A?
Yeah. So it's really the down move on 2 high volume bars with the next bar up here.
That's right.
Yeah.
And what I would say is she's correctly highlighted the fact that the previous bar was probably the start of the accumulate or start of some buying in there, and she's drawn her trigger number, your trigger number, from the high of that bar, which is exactly what I would have done. And you notice how we've gone up, we've hit that line a couple of times, or 3 times now with the area to the left at the moment. And then she's drawn from the low of the second bar in A, which is the bottom of the accumulation.
So notice that's the highest volume on the chart that we see.
Exactly, yes.
So we know there's something going on A. Yeah.
And the market, although it has poked down below there a couple of times, is quite reluctant to spend any time below that level. The only thing I would say is looking at that, I would suggest that stock is probably underperforming the index.
Should we have a quick look?
Yeah.
Okay.
Is that a member of the S&P, that one?
Yeah, we actually did pull this up to look at. So first of the things we're going to do here is look at where we're at in our trading range, and you can see that it's not up down, it's sideways moving. It trades sideways here. The weekly gives a slightly different picture, as you can see. So it's almost got this big accumulation phase here and then distribution up at the top. So you've got room to go up here. It plummets pretty heavily here, but what's interesting below us here, there's a lot of accumulation at this base. You can see all Tom's signals all clustered together. That's interesting, Tom. When you get a cluster of green signals at a base, it's almost like it's telling you, and it starts to move sideways, that is the start of the accumulation. Now if we look here, this is what, and I've built this, I'm going to build this from scratch here because I put a load of lines on this earlier. I thought it'd be helpful to actually show you what I do here. Now the first thing I want to do is mark the bottom of the chart as I see it, where the price action stopped here. And what is interesting, if we look at the low of this bar here, well, notice here that the low is at 47.54. So we're going to put a line right on the low here. Now you must always use, I use the lines in Trade Guider. There are several other ways of doing it. I put a nice big lime green line on it to say that is the stopping point there. Okay. Now the next thing I'm going to want to do is, now I've got my low. Where's my next low? Well, I can see here it's going to be around here, and this will probably project out. So we're going to do a nice trend line here. We're going to take the low from here, and we're just going to hold it onto the next line. This is how you draw a trend channel. This is how Wyckoff would do it. This is how Tom would do it. We take our, because we can see we're now in a weekly uptrend, which we are. We take our first two lows, let go in the program, and it should select the intersecting high, which it does. Okay, now I'm going to put on my playing field. Now, why is it called a playing field? This was a term that my predecessor Todd Kruger used for a trend line, and I'll use the analogy of the playing field because I used to play soccer or football. I mean, when I go to America, I have to say soccer, because if I say football, they say, you don't look big enough to be a football player. And I'm like, no, I'm a soccer, you know, kick the ball around. But there's always, when you play a sport with boundaries, there's goal lines, always. And you have, for instance, in soccer, you have two goals. We have one goal, which is the opponent's goal, and your goal. Now, I liken this when I'm looking at a chart. Now, notice how I projected that out in the background, and look what's happened here. See how it's hit the base? There's no accidents there. Tom taught me about trend lines long ago, and I said, oh, well, he's the master. He'll be able to explain to me why they work. And he said, well, I've no idea, Gavin, but they do. So, but he used to, he's got in his shed, and I'll get a picture of him before we go. You've still got that ruler in your shed, haven't you, Tom?
Oh, yeah.
It was 7-foot ruler. We'll get a picture to send to you all of Tom with this 7-foot ruler. One day, it'll be a famous picture, I'm sure. Because what he used to do is draw the trend channels for the syndicate, and I'll ask him to talk about that in a minute. Now, here, what we can see is that the market is respecting this channel. Now, look where I drew it, okay? Here and here. And if I come out to the right edge, remember, that's where I've drawn it. Now, look at what happens if I move to the right edge. Now, there's nothing unusual about that. Trends stay in place for a lot longer than we think they will, which is why really you want to trade in harmony with the trend, and you must be able to draw a channel correctly. There's a very good book I'll recommend to you. It's called Sticky Stock Charts. Some of you have got it. It's S-T-I-K-K-Y, Sticky Stock Charts, by somebody called Lawrence Holt. Have you got that book, Philip? I don't know if you've got that
No,
one.
I haven't, no.
Very good book, and it teaches trend channels. But looking at the analysis that we see, first of all, the best place to buy this stock is going to be when it approaches this level. Well, we've missed that now. It was down here. The low of that bar there showed some nice high volume, as we can see. It was at about 99, almost at $100, so a round number, and it's gone up for a few weeks. Now look, it hit no demand. There's the signal, because they want to buy it a bit more. They come back down on this bar here. Definitely looks like there's buying in there. The next bar's up. So now we're taking out the no demand bar. It's closed higher, which is potentially bullish, and we've got a target just above us here. Now let's have a look here. So the target, initial target anyway, where we've got to take out, is going to be the high of this bar here. So I'll mark a line on this as well, and we'll put this one in red, because this will probably now establish a trading range, highly likely, and then we can drill it down onto the daily chart and put some numbers on it. Okay, now look, we can now see where we're at in our trading range here. Now what is interesting is we're forming an arrowhead. which I'll also get Tom to talk about in a minute as well, is we're trending up on the weekly. We've got a really serious level above us here, which has acted as resistance. It's poked through it here, look, and come back down. So if this were me now, I mean, I do think the stock's going to drift up a little bit, but it has got a lot of resistance above us, and I'll tell you, so has the index. So do not be surprised to see it hit that top and come straight back off if the index doesn't push up through. Now, the FTSE, Philip, what was the news yesterday about the FTSE?
Well, in the paper, I think it was on the front page actually, FTSE hits 18-month high.
That's good news, isn't it?
Which actually, when I looked on the chart, it's actually absolutely level with the high it made in, I think it was December.
So now we're critical.
So we are critical, yes.
And the FTSE, and
yes.
Of course that had something to do with the pound at the moment as well.
It did, because if you look at the S&P is, I can't remember which I'd looked at the three indices, I get confused.
S&P's right, it's actually very close to an old high to the left
I think
as well.
It's the Dow is the one that hasn't quite made it yet.
No,
it's a bit weaker.
S&P's
but of course
leading.
the currency does have an effect because the FTSE is very much an international index.
Yeah.
And as such, the FTSE companies tend to gain by the weakness of the pound against the dollar.
Yeah.
And that tends to, because the FTSE is actually quoted in sterling or pounds, that means that the value of the FTSE has probably gone up that little bit more than, say, the American indices.
Yeah, great. Now, Tom, I've just put a channel on there, like you taught me to draw. You know, you take your first two lows intersecting high, and you just leave it. You project it out. It's amazing, though, how many times this particular stock at the right edge has hit the channel. It came back down here, look. This was my point of reference. It came off. There's the high. Now, we're in this quadrant at the bottom of the channel, which means we're in a buy zone, because we are in an uptrend, and you can see the software tells you we've got more green diamonds than red, so we're definitely in a buy area here. I'd love to see this stock come back down to around this level here, about 105, and test there. That to me would be very attractive if that test held. Tom, trend channels. The syndicate, when you first got in there, gave you a big ruler, said, right, off you go, Tom. We'll send you off on the Wyckoff course. Now you're going to be drawing trend channels. Why did they need that? They've got enough money to move things around. Why did they need trend channels?
Well, no, you need trend channels to see how the stock's behaving and what support it's have. You would expect support on these trend lines. Now, as you say, why they work, I don't think there's been any scientific investigation into that, but it's obviously something to do with the way the herd behaves. The herd does tend to behave the same way. You may think, oh, well, but in a way you are an expert on herd behavior, and you can more or less say you are, because you know that at your local, say, post office, you know the time to go there when it's quiet, and you're frightened to go there when it's busy. Why? Because the herd does the same thing day after day, the same thing, very similar. You personally might say, oh, I never do that, but as a part of the herd you do it. And this is why probably, well, I'd say definitely the way trend lines work. You could draw trend lines on anything as long as you've got the data. You need the volume, and of course you need the high-low close of volume. You can draw a trend line on car accidents, house prices, if you have the data. And luckily in the stock market we do have that data. Now, we used to have, there was no computers, of course, when I was there, so we used to have charts. We used to keep adding to them, and they finish up about 6-7 foot long, these charts. We used to draw the trend lines in pencil first, and then if they're only useful when the data arrives at these trend lines in the future. If they're obviously way, just rub them out with a rubber. Mm-hmm. So to do that accurately, you need a proper ruler, a good metal ruler with a good straight edge. I still have it lying in the shed there. Mm-hmm. as you said.
Well, it's next to my fishing rods, so I know where it is.
Next to your fishing rod.
That's it.
Now, when we started formulating this, I remembered doing that, and luckily the programmer had a lot of insight into how to do all this, and he came up with the trend clusters.
Now, I've shown them on the screen now on this chart. Now, the trend clusters are only valid when their price action is at the right edge of the chart is near a cluster, correct? We disregard ones behind us because they're gone. The computer updates itself, and we're interested in clusters at the right edge. Now, I've looked at the weekly chart, and I can see, look, as the price to proceeds 130 up here, this is the cluster that's in play. Okay, it's very important. See this one here? So I'm going to have resistance at 130. No surprise there, but there doesn't appear to be a cluster immediately above on the weekly. Now we go back to the daily chart here, and we'll go to trends, and we'll put trend clusters on. And now we see that we're stuck in a cluster at the moment, right here, at the right edge of the chart. So we know we're going to experience a little bit of resistance up here. Is there any surprise that we're going to experience resistance by the looks of it? Well, look, if we look back here and we put our marker across here, it's almost where the particular lady concerned, I nearly said her name then, which I said I wouldn't do, but there we go. So there we are. So we can see, look, the cluster now confirms the resistance there. So if someone said to me, would you take a trade here now? There's two things I'd do right now if I was going to buy this stock. I'd wait to break 117 and look for a no supply test in a rising market type of indicator. We have had something here. We've definitely had some buying on this bar because the next bar closed up. Look at the narrow spread here, and the next bar comes down and pushes up. Then we get lack of selling on this bar and it goes up. Then we hit our resistance. I'm sure the cluster probably would have been there the day that was there. It comes back off, and we're trying to have another go through, and we can analyse that on Monday or Tuesday to see if we push up through. If we do, then we've got a target above us up to this old high to the left. So there is some room there for those short-term traders. The arrowhead, Eric, is very easy to explain. In fact, let Tom do it. Tom, when a market has a top and it's trending up and the top keeps getting hit, it sort of squeezes in almost like an arrowhead or a flag, if you like. I mean, it's here you can see it looks like a pennant. You've got this top on the weekly and you've got this trend channel. And you notice we're slowly squeezing into it. That's usually a sign of a breakout. We saw it on Thursday. Tom, talk about that pennant sort of arrowhead shape as the market moves into it.
Right. Well, if you draw a trend line from the lows, and then draw another trend line, not level with that, but from the highs, the two highs, very often you see the data moving into what we call an arrowhead. Now what that actually means is that supply and demand are gradually becoming equal. The stock market does not like that at all. The stock market does not like being equal, and it will break out either up or out of that arrowhead rapidly sooner or later, and we see that quite often. Usually if it's going to break up to the upside, there'll be testing low volume down bars in the background. If it's going to break down, then you'll see up thrusts, no demand up bars at the top. Always remember, weakness appears on up bars, strength appears on down bars, always. So please remember that. But the arrowhead is very, very interesting. It's really a warning system that's going to break out suddenly. Markets don't like equilibrium.
Okay, Philip, you see here we've got, I think Chris asked, is this a wedge pattern or ascending? You know, you've got these an ascending and descending triangle. Is that pretty much the same type of thing here?
Yeah, one thing I was noticing on that weekly chart, if you look at the centre line of the trend channel,
yeah, this one here,
second dotted line, which is in the middle.
Yeah,
look how we've gone up. We seem to keep hitting that and bouncing off it.
Very interesting, isn't it?
That's acting as clear resistance, and those quarter lines and those centre lines do work. I've tried them.
They definitely work, and they're unique. I don't see many other programs that have them like this. In simple terms, we have what we call the buy zone down here. If we come out of a channel on high volume down bars, stopping volume out of this channel, next bar up, well, that's a very good place to buy, isn't it? If you're in an uptrend,
because
yes. you're going to be oversold, correct, down there, and then up to the top of the channel. If it goes out and you're in a downtrend channel, so the opposite, and it pushes up, then you're overbought. That means it's probably going to come back into the channel. So that's a very important principle. We didn't spend a lot of time on that last week, but I know that when you're selecting any instrument, being able to draw the channel is absolutely important. This is a wedge, Brad would say. I'd agree with him. It's more of a wedge shape, this one, rather than a wedge. It's a wedge. It's a wedge. Yeah, it's a door wedge. So Brad just typed that in. It's not a triangle, really. It's not. It's a wedge because of the shape that you've got. You've got this here, and you've got this line across the top. If it was going to be a triangle, you'd expect to have some highs in the back, and you could point to more of an arrowhead. This isn't the perfect arrowhead shape. We had a better one, didn't we, Tom, on Thursday when we traded on the intraday charts. But so in summary, then, I think the lady in question who likes pot
One other point.
I think the long answer, very good, very
Yes.
good analogy, definitely. Very, very good analogy. We've got a couple more minutes till the film finishes here, so we're all right for time? Okay, good, yeah. So, 10 out of 10 or 9 out of 10?
Definitely 10 out of
I think
10,
very
I think,
good.
yes.
Yeah, 10 out of 10 for that. Very good analysis.
Can I just add one thing in there, Gavin?
Sure.
You, on that weekly chart also, you talked about it going up to that trend cluster.
Yeah.
And that trend cluster just happened to be at that centre line as well.
Spot on.
Yes. Which,
There's no accidents here if you know how to read a chart.
definitely not.
And
No.
this is a chart reading masterclass, and you can see when that chart there, was sent in. I didn't even have to study it very much because you can see all the principles. So, well done, 10 out of 10 for that one. Let's move on to the next question. This is question 4 actually, so beg your pardon. Sorry, question 3. Beg your pardon. This is question 3. Can the pre-market data, as shown in the attached chart, be used with confidence on the opening to catch the opening move? And I know Tom's going to have a view of this. This is a chart of the E-mini S&P contract on the 22nd of February. It's a 9-minute chart. I normally use the 3 and 5 minute charts on open, but those are no longer available. I didn't understand that part of the question because you can get 3 and 5. But anyway, what I want to be able to do is catch the sudden move as shown in this opening. So this is basically the E-mini on the 9-minute chart. Now, first of all, we know that we have what's called a Globex session, and you're currently using the HO contract, okay, which is the March contract. Now, it's using the current contract. Now, if you use the Pound F contract, you get the Globex. But we're getting a question here, Tom, about the volume spikes. I think that's part of the question. Is the Globex trades overnight, as you know. And we get sudden surges in volume, and then you get low volume, and then you get high volume. But of course, suddenly at 8:30, the market opens, and the computer just sees this very ultra high volume, and it's comparing it to, 14 bars previous, and it sees it as unusual volume. Now it is, and I've always maintained that is professional money active. The market always seems to open on unusual volumes when you compare it to the previous bars. So the question comes in, and I'll just go back and repeat it. Can the pre-market data, i.e. the Globex, be used with confidence to catch an opening move on the futures contracts like the S&P, for instance?
Very often you can. When I do the seminar Fridays, I always like to see the opening of the S&P 500 on a 5-minute chart or something. You've got to be very careful because the volume will always look high because it's comparing it with the Globex, which is obviously very low. But you can see, if you can analyze the market before the main market opens, lo and behold, that volume then jumps up and it looks fairly normal, the overnight Globex. And you can see lots of things going on there. You can see upthrust, you can see testing, all sorts of things going on. But when the main market opens up, they're gunning for you, they're whipsawing the market, something terrible. A lot of those professional traders are not sure which way to go. They're all in there checking all these, whipsawing. And then after an hour or so, it all settles down and we have a fairly clear picture of what's going on. But that's how I look. Sometimes it's very, very obvious what's going on. Sometimes it's a bit confusing.
Yeah, and I'm just showing a 3-minute chart here. This is a 3-minute of the E-mini S&P. We can see that you can definitely see the overall trend from, this is the overnight session, as you'll see, from Chicago, from 2 a.m. through till 10 a.m. You can see the unusual volume starts coming in almost at the open there. And you can see the trend. So there's a lot of things you can do by using the Globex, but we have seen recently more and more unusual activity and high volume, very high volume on Globex, especially the last 6 months. So I think the answer to that question is yes. Use the Pound F contract if you're not comfortable with using the HO, especially around contract rollover time. Use the ES space £F comma time frame. That will give you, in fact, you can see on the NASDAQ, that's what I've got here, is the Pound F on the 9-minute. And you can see, yeah, look, of course we do get during the trading day the volume, but the price still moves overnight. It has to, because it's still being traded. It's actually, there is a Globex session there. So, that's why you actually have the Globex running through there and the price moves. So, yes, you can get a clue. And in fact, this chart here shows it nicely. Okay, here on the NASDAQ here, you see this very high volume, which is at 7:48. So, 10 minutes to 8 Chicago time. And then, again, if we look, as they open the market, they gun the such right at 8:51, just before New York time. They gun to take it slightly higher. And then you get a beautiful supply confirmed coming in, and they bring it back down right the way through to the overnight Globex start where it began to rally. So I hope that answers the question. I think it's not a difficult one to answer. The answer is yes, you can use it. And I didn't understand the question about I can't get a 3 and a 5 minute chart, because you absolutely can. I don't know if you're using Trade Guide or not, but you definitely can get that. Question 4. I just got this trade today. Now, I know that when this came in, this was a specific question asking for trading advice. We cannot, and we're not registered to give specific trading advice to you about what you should do with your positions. We can only give you our opinion of what we can see on the chart. You are the best person to manage your money. And I repeat this, you can read the chart, you have to make the decision. But the question came, I got this trade, Bank of America issued new warrants. I'm providing the A-series warrants and the common. I have to trade out the warrants by settlement Tuesday night. These images are available from Interactive Brokers, and he's not used a Trade Guide chart, it comes from IB. Okay, and then it says, so the question, should I trade them out Friday? Okay, well, let's have a look at the big chart. We can't tell you what to do, but we can have a look at the chart and see if there's any serious signs of weakness or strength to give you an indication. Now, the first thing I did was I took a look at the weekly chart of Bank of America, and we can see that the weekly trend has definitely been trending up, but we've hit sideways movement, as you can see, for several weeks now, because it's just sort of staggered, and we've got what I hate to see on a chart, which is called the Christmas tree effect, which is where you've got all these white diamonds and it's in some sort of consolidation zone, got a nasty little hidden up thrust here, so you've got weakness right above you around this close of this price, right on where you are now. So there is definitely a need to push through that. But let's go and have a look at the chart itself, and we'll have Philip come in and have a look. Philip, weekly Bank of America, what's your initial view of that? It's definitely trended up, but it's sort of gone into a sideways movement, and I found that quite difficult to read.
Yes, I'm thinking the same thing. The first thing I do when I look at a chart like that is to try and pick out some high volume bars. And I can see two very high volume bars on that chart, and they're both up bars. That's the first one, and that's the second one.
I read your mind.
Yeah, you did. Yeah. You normally do, actually, Gavin.
There you go, yeah.
So that's the first thing I say, and that's why this market's running sideways, because there's certainly weakness from those two bars. Now, having gone down from there, what else have we got? Obviously, we've got strength right in the background, back in February, March 2009, which is when the market started rallying. Yep. There's an up thrust there that Tom is just picking out, which has knocked it off on the very high there.
Yeah.
Now, have we got any really strong? Have we got any strong bars? I mean, a couple of bars later, there's a bit of strength. There's some buying coming in.
One?
Yeah, that's the one we just pointed out as weakness.
Yeah, it's narrow.
Down bar.
Yeah, it's an up bar, and it's narrow spread. It knocked it down for several weeks. Then you've got these very unusual bars here. Yeah. They're very narrow spreads. I mean,
that's the Christmas period.
There you go. So that's why. So you can't really see much. And then it knocks it down, back down to the, well, this is on the bottom of the trend channel. That's the first low I could find. And it has gone up for 2 weeks, okay? And I'm sure that bar, if it shows it's low volume, let's compare it to the 820, 838 there. Maybe the daily will give us a better clue.
Well, you see, there's a bit of buying on that 1, 2, 3, 4, 7 from the left. So 7 for the right. There's a bit of buying on that bar, which is, as it approaches the bottom trend line, that's been tested. But then that last weekly bar, the last completed one, the red bar, we've got a little bit of supply coming in there. We just have to, that's a very difficult one to read at the moment.
Now, Brad makes a comment here on this bar here. He says, you've got quite high volume on this bar here, next bar closes up. So you've definitely got some buying in there.
Agreed.
And then you've got almost like a test, which responds.
Yes.
So you've got really, it's a very difficult one to call. You've got serious. It's always like the other charts. You've got resistance above you, but you've got some strength behind you.
Yes.
An immediate background on the weekly.
It's just the chart you don't really want to look at.
Well, no, but we've got no choice because
that's fair enough.
Yeah, and there's look here.
Very difficult one.
We've got two lots of buying here on the daily. There's your test here. Look, and it's a gap down, very narrow bar into this bar here where there was some buying. There's no selling pressure, and it's gone back up, but it's back up to resistance. This is not an easy one to read. I wouldn't like to call that either way, I've got to be honest.
I wouldn't. It's very much in a trading range.
It's in a range, yeah. It's a very difficult one to call. Sometimes the principles are going to be very obvious. If it was me, you're asking me, would you trade that now, one way or the other? I would need more evidence, because to go long, I've got very limited upside to about 17.50.
Why struggle with a difficult one when you have so many easy ones?
Well, in this instance, Tom, the particular customer concerned is actually in a position here and was asking, what would you do? And he's asked a question where it's not particularly obvious what you would do. I would, if it was me looking at that chart now, I would step aside and look for a better opportunity.
I would.
And the stock scanner in Trade Guider, which Philip, I'm delighted to say, is going to be doing a seminar on the VSA Club in a few weeks, aren't you? And you're going to really focus on stocks, which I'll tell you about at the end, so that you'll be able to come in and ask Philip about your stocks and what's going on, and we'll be able to look at these breakouts, and we're going to be scanning for end of a rising market, bag holding, all of those things, and we'll look at the ASX, we'll look at the FTSE and the American markets, and obviously I'll be there for a while with you as well, so that should be exciting. So, the question was, what should you do there? I have to say, it's a very difficult stock to analyse, and I would basically, you have to make the decision what you're doing with your trade there. You're at a serious resistance level, but you've got buying behind you.
Yes, I would say what's happening there is professional groups are in a battle and they're fighting out among themselves.
I'd agree, definitely. Okay, question 5. I've been looking at the futures. That's a pleasure, no problem at all. The gentleman concerned just said thank you. So, I've been looking at the future spreads. I trade for VSA principles with inconsistent results. I was wondering if you've traded or even looked at spreads using the VSA before. Spreads I trade are the HOECLE, the RBECLA, which is on the Globex, and WTI Brent ICE on the ICE exchange. I'm very interested in VSA and wanted to back test some of the principles. Would you explain how I could best quantify some of the principles in order to do this, please? I guess I'm asking you if you think there are specific rules that can be applied to automated trading systems. And this is Tom's sitting here rubbing his hands with glee here because he's working on exactly this, so he'll be able to answer that. Can VSA principles help my current black box approach, or should it not be combined in order to help with stops and exiting strategies? I think there is something there to use with both grey and black box approaches, and very excited about learning more tomorrow because we got this yesterday. Now, I am not familiar with these spreads, and I don't think you are, Philip, so I can't really comment on those. But what I can comment on, and what Tom will most definitely comment on, is the back testing of principles. More importantly, can VSA be put into an automated trading system? Tom?
Well, I mean, if the indicators of strength or weakness are accurate enough, I can't really see why you can't have an automatic trading system on it, to be quite honest.
Okay, now the gentleman asked in the question, can you back test the principles of VSA? Philip, do you think we can? I mean, when I ask, see, back testing to me, I've never used back testing because I think anything that needs back testing is flawed in the first place.
Great.
Because it's looking at the past price. Now, VSA doesn't really do that. And you can see a principle in the background and see it. It was there. If it was there in the background, it had to be there on the day it appeared.
Yeah.
Unfortunately, as human beings, everything else around us, all the information coming into us, will not allow us to see that. Or we'll do what I do sometimes. And I know Tom has slapped my wrist a couple of times because he said, look, you're trading off certain rules that I trade, and I trade off fairly strict rules, which means I miss some moves at the top and the bottom. And I do, and I accept that. That's part of my trading style, and I show people, look, I'm trying to get a low risk entry, which is why most of the time I'm able to make money in the markets because I'm taking the lower risk entries. But that you can identify the tops and the bottoms, I'm convinced, using VSA. But back testing, now Philip, you did study technical analysis. You threw most of it out in the bin.
I did, yes.
Because you weren't making any money with it. But a lot of people love to have the security of saying, look, I've got a system. It's based on a MACD or a moving average. Look, I tested it over 2 years because the market was probably in a bull run when they were testing it. it produced excellent signals. They go to the live market and wipe their account out. I hear this countless times. Why?
But actually, with Trade Guider, you can backtest if you want to. It's ever so easy, because everything that comes up live. You've got the signals on there. What you want to do is to pick a chart where you've got, if you say you've got a daily chart, you've got 5 years of data on the chart. What you need to do is to go back, say, to the first year of the data, put your cursor on a particular day, and if you press the arrow key on the keyboard, you can move forward a day at a time, and the indicators will come up as they would. Probably best, if you're going to do that, to turn the yellow boxes off and actually have the live bar confirmation on, and everything will come up exactly as it would have done had you been following it day by day.
So will you show that in the seminar next week?
Yes, quite happy to do that.
Just show them how you backed it, because it's interesting.
Yes, very easy to do.
Janet says, Gavin, I backtest VSA setups on stocks to see if history repeats itself. Isn't that interesting?
History does repeat itself, but never in quite the same format.
No, Philip said that, yeah. Then I'm more confident about taking the same entries in the future. It's interesting to see how often they see that is pot stock I'm going to have to start following. What do they make? I don't ask. I think it's actually manure, or I believe, Janet, isn't it? They make, isn't it Potash, the company? No, Richard, it's not marijuana cigarettes, thank you very much. Fertiliser, it is, that's what I thought. Yeah, I did know Potash, because it is. Yeah, I don't follow the stock particularly, but I know a lot of our customers do. But it's interesting to see how often pot has repeated itself over time. Yeah, very interesting. Now, therefore, what we're saying to answer this particular gentleman's question is you can't backtest price action, because we don't look just at the price, do we?
No.
We look at three components. But you can go back, and I do this all the time, with even on the E-mini S&P, and look at background and then a formation, and you'll find sometimes almost identical setups that we taught you last week will be there, and now you'll have the confidence to pull the trigger.
Exactly.
So, Tom, automated trading system will be based on what? Well, you'll put a system in that looks at the background and the signal, and it will just automatically put in the order to the exchange, put a stop in place that you'll define, and then you'll let the thing run using your trending system, I'm assuming?
Well, we have to test it first. But basically, if a green signal appears, you're going to go long. And you'll have an automatic stop on an odd number underneath that. And if the market goes up, it keeps moving the stop up until a red signal comes, and then you sell out. Now, it'll probably work these days because the round turn is a lot less than it used to be. When we first tested it, believe it or not, it was £20 a round turn. I remember it very well. And of course, there was more signals than we needed, and that's why we put it to one side at that time. But since then, we've improved, obviously, the indicators tremendously, and they will be improved more as well.
Philip, you're a professional fund manager here in England. Do you believe that volume spread analysis could be automated in the future, and potentially you let the computer run the trade for you?
Yes, I think it probably can. Whether it would produce as good a results as a really top-class trader or investor could produce by actually looking at the screen, I have doubts, but I'm quite sure it could produce profitable trades. Because
the one thing that most traders are guilty of is getting out of the trade early.
Yes.
A computer wouldn't do that. It would look at Tom's trending. And I have to be honest with you, when I say guilty of it, when I was at the New York Traders Expo Challenge, Tim Borkman asked the question, do you get annoyed when you've taken a position off only to see it run another 6 points? Well, I personally don't. Actually, it's built into my psyche now to be grateful for the trade I've taken and know that another one's coming, maybe in the next minute or maybe in the next 2 or 3 hours or maybe tomorrow. But I don't try to get frustrated with the market, because generally when you do, it'll come and eat you. Do you find that?
Yes, you'll then try a revenge trade, won't you?
Yes.
Which doesn't work.
No. No, we'll talk about that. That's another subject in its own right. So, yeah, the VSA principles can certainly be back-tested, but not based on price, based on patterns. Pattern recognition. I'm a big believer in something called NLP, which is called Neuro-Linguistic Programming. And in fact, Peter Offen, our VSA Club manager, is this weekend attending a course by Anthony Robbins. I've attended a number of his courses. And really, when you look at what chart reading is, What we're teaching you to read is high probability patterns that are there at the right edge, and to then act on them. Correct, Philip?
Yes,
And
absolutely.
once you see them, we help you, because we even produce a signal that doesn't require the intervention of a human being, because Tom's already done all the hard work. The problem is, and this I know to be true, is that the human being, including myself, and I've got a business partner here filming me, who just looks at the chart, and honestly, he just said, well, there's green, there's red. So on Monday, I will be giving him the live account, and we will be seeing the results, which I hope to publish in the VSA Club. There is a challenge to Mr. Richard Bednall, live on camera. Let's see if you can do any better than I can. So we'll see. Right, Gail Mercer says, and Gail runs Traders Help Desk, which uses volume spread analysis now, and Gail's becoming an expert in her own right. So she's here today with Harry. And the problem with back testing, she says, is that most traders would not actually trade it on the live edge of the market the same way. Exactly. Most of the traders I've met that have blown their accounts out are using some sort of mathematically based system without any real logic, and they don't know why the signal's there, so they just take it anyway. And occasionally, that's the damaging thing, they make 3 or 4 winning trades, and they think, I found it. And then they put the big money on the last one, the 5th trade, and lose the lot.
Can I give an example of that?
Yeah.
Because I've been guilty of that before I really understood VSA. I bought some software, which cost quite a lot of money, and back testing showed, it was trading currencies actually, showed I think it was 75 to 80% success rate.
Right.
And I found later that it was based on moving averages and stochastics and all that type of thing. I bought the software thinking I was going to make a lot of money without too much work. And there's probably many of you thinking exactly the same thing for them for that one. And when I actually tested it, I think the results were something like 30% success rate. But it had been back tested, but the whole point was it hadn't been by back testing, you're not testing live in the market.
Mm-hmm.
And of course, as soon as I started using it, it started losing money. I had the good sense to quickly ditch it before it lost me too much. So
it's interesting, I will show this at the end, that a gentleman called Tim Raymond, Tom, was one of your mentees very early on. You actually refused to sell him the software initially. And he's turned out, he won the World Cup Trading Challenge for Forex with a real 44% return in a short period of time.
That's right.
Which proves he can do it. Now, he's using VSA principles. He acknowledges you in the article. Now, when Tim came to you, why did initially you were reluctant to sell him a £5,000 program? I mean, that he actually wrote that in the article.
Well, the reason why, I remember, and he says, the fact is that you turned me down, made me more determined to get it. I remember that. But don't forget, when I started, it was a hobby. I wasn't doing this seriously as a commercial project. I was interested in whether these indicators or signals could actually be programmed. I'm not a programmer, so you have to employ these guys. And I was lucky enough to get hold of a programmer that could actually knew more or less what I'm talking about and could do it. But most programmers you're going to have a lot of trouble with because they don't understand really what you're talking about. But Tim came along, I remember, and he wanted to buy, and I said, well, look, Tim, don't forget, most people lose money in the market. I don't want to see a nice guy like you losing money. Think about it. And he said, right, when I said that, he was more and more determined to buy it. But don't forget, when you see these indicators appear, right, if you put the cursor over them and press Control F, a box will come up. Will tell you what the indicator number is as a number, right? Be minus 20 or something. Then how many times it's occurred within the chart you're looking at. Press OK, and it will then, if you press N, and what's the other one, Philip?
P.
P. Right, N or P, it will go through the chart, showing you exactly where these indicators are. And you can see for yourself if they're any good or not. I think you'll find most of them are quite good.
Yeah, no, interesting. Thomas has just said, do the back testing as paper trading at the right edge. Absolutely. I mean, if you've got a system, Paper trade it for sure. On your screen there, just before we go to the next question here, this is Tim Raymond. This article will be available. We'll be sending it out to all of you shortly to read. We've actually purchased the rights to this, so you can see. But yeah, this is the challenge. I'm going to be entering this challenge for 2010, and during the months of March, April, you'll be able to follow my progress in the VSA Club Forex trading room, which will be run on Wednesdays. And I'll be keeping you abreast of all my trades throughout the VSA Club. But what was interesting here, yeah, I remember saying to Tom about this, I couldn't really believe, this is superb marketing for Trade Guide. I'll make no apologies for that. But he talks about, really, Philip, a little bit how you got into this journey, dabbling with the markets to start with, and learning how the markets operate. And then he began to look at what is the truth. And he says here, just briefly, it was not until nearly a decade later that Raymond began dabbling in the financial markets. He started following UK warrant prices in the newspaper. I liked the volatility and I thought I could make some money trading. Haven't we all thought that?
Sounds familiar.
During the next several years, while continuing his full-time work at the Times, he's a... Tom, am I right in saying he's a prize-winning journalist?
Yeah, investigation journalist.
And he won the equivalent of the Pulitzer Prize,
yes.
Is that right?
Yeah.
So a very intelligent guy.
Oh, very.
Yeah, okay. During the next several years, while continuing his full-time work at the Times, which is a major newspaper here in the United Kingdom, Raymond tried trading bonds and index futures. It wasn't based on anything, he says. All I can say is that I traded amateurishly. However, Raymond tasted something that he liked. It's probably the same for any retail trader who doesn't know what they're doing. You get a taste of something that is challenging and exciting. How true is that, Philip?
He's traded almost followed the same path I did. I used to try warrants because I liked the volatility.
Yeah.
I tried index futures and what was the other one he mentioned? It was almost the same path that I took.
Yeah, interesting. And he says,
It's
the
strange,
warrants
isn't it?
and the bonds. And in 1998, so that would have been 10 or so years ago, Tom, just as business was booming, Raymond had the good fortune to connect with Tom Williams, the creator of volume spread analysis. I rang him and he was very reluctant to sell me his software. Tom, what are you doing? You're supposed to try and sell the software, not sell it. He said, you just confirmed this, trading is very difficult, you know. I insisted and agreed that I would pay £5,000 in instalments. Is that right?
Yes.
Amazing. And these days, if I'm asked by someone who is starting out in trading for advice, the first place I send them is the Trade Guide website. For me, it demystified the markets to a great extent. Now, I think that's a great compliment from a world champion trader.
Oh, yeah.
But clearly, demystification of the markets, that's a very interesting...
term, isn't it?
Yeah. Now, the next question leads us nicely into that. The question came from a gentleman. He said, I've heard Gavin and Tom mention that 90% of retail traders are on the losing side of the market because the market has to have losers. Can Gavin and Tom explain why they think that is and what makes a consistently profitable trader? Now, I've got my view, but Tom, what's your thoughts on that?
Well, I mean, it's well known, these statistics. They've been around for many, many years. Like option trading, it's well known that 85% of all options are never exercised. This has been going on for years and years, this. So it means that 85% of the people who trade options don't make any money because they're not exercised. And it's the futures is estimated to be around about 90%. What we try to do is to move you over to 10% that at least had the chance of making money in these futures, something like you see Gavin doing. But even stocks and shares, right, it's fine if you hold them for 10 years, you make money because the market goes up on inflation. But these statistics are around and they don't change because the herd tends to do the same thing all the time.
Yeah, it's interesting. And Philip, I mean, I've never heard you say that, but that's why the particular gentleman asked the question. But I've got a view. You are successful. You now manage other people's money, which to do that takes some doing as well. You've been through the journey. Why do you think so many retail traders? I mean, this statistic, by the way, we didn't pull out the air. There is a graph that I'm buying the rights to which show this. That internationally, it's a very high percentage of people. Now, obviously, Tom says it's because the market has to have losers. But when you look at the skullduggery that's going on, when you look at the information isn't lies. Well, sometimes it's out and out lies. Actually, if you listen to Jim Cramer, sometimes you're told something that's completely wrong, only to find out afterwards that in fact it was a complete lie and you've lost money. But taking all that into account, we don't care because we can read a chart. Is that right? And so why do you think, though, so many people just cannot get grasp this? Is it because they haven't found VSA, or is it because they're just blindly following like sheep the news and the newspapers and past price analysis and trying to just buy without, like Tim Raymond said, not even knowing what you're doing, but it's exciting and it's thrilling?
I think there's many reasons, but probably one of the reasons I'd highlight is the news. Most people read the newspapers or watch TV, and particularly some of the business channels, and they naturally believe everything that they hear.
Yeah.
It's reasonable enough, I suppose. You watch and you hear somebody who's brought on as a so-called expert on a particular market or stock, and they're bullish on that stock, and it's reasonable to assume that they know what they're talking about. Chances are, if they're bullish on the stock, it's been going up for a long while, because if you listen to these channels, you'll find that when the markets are down in the depths, it's very rare that anybody has the courage to actually come on and be bullish, because they're normally following the trend. Equally, when the market's at the top, everybody's telling you to buy. But the whole point is...
Like Morgan Stanley was a great example,
exactly,
that JPM stock. Yeah.
By then everybody's bought it. There's nobody else left to buy. So actually, if you worked on consensus, which is really what Trade Guider is based on, it looks at the consensus of the professional money, that's the ideal solution, because you don't want to be buying when everybody else has already bought.
Well, the Master's putting his hand up.
I'm just saying.
Yes, Master.
Well, I'm saying, you have to have more losers than winners, but this is the logic that goes with it. You take a second-hand car dealer, you have to have more losers than winners, otherwise you wouldn't have a second-hand car dealer.
Yeah.
You have to have people willing to dump good cars onto the dealer at very low prices, so you give them a nice wash, clean up, and put them on the forecourt and resell them at a nice profit.
And just backing that up, I was reading an article either in today's paper or yesterday exactly on that very point. I think they said roughly 85% of people have a problem on a used car within the first 3 months.
Yeah.
So that backs that up perfectly, doesn't it?
Yeah, amazing. Well, I've got my view of this, and I'm very fortunate in that I've travelled all over the world doing seminars. I've been to the Middle East, I've been to Australia, I've been to Malaysia. I've met so many people. And I've also met, fortunately, when I was in Malaysia, one of the top fund managers there. I've got a great friend out there, Bill Wermine, and also in Australia, there's a guy there called Nick Raj, excellent trader. But there are certain traits that make up good traders, and I think this is, for me, what makes up a good trader. Now, the top there, I've put belief. And in the document that I sent you all, I asked a question, not a trick question, a genuine question. And the question was, do you believe that you can make money from the financial markets? And 100% of you said yes. 100, not one of you, and we fully subscribed, not one of you said, no, I don't think I can. So I already know that you're halfway there. Now the question is, can we get you all the way there? Now, I'm going to talk about belief, and I want to read a document that was sent by a Trade Guider customer called Rakesh Kumar. Some of you have got this document. He's allowed me to use it. I've got permission. He sent it to me 3 or 4 years ago now. And I just think this is, I can't claim to have written this. It's Rakesh. And, if he's listening to this recording, I'm very grateful for him to allow me to read this. Because it really sort of summed up for me, actually, why a lot of traders do fail. And it's because of self-doubt and self-sabotage. It's nothing to do with their chart reading skills. It's actually themselves. They're their own worst enemies. And I know that, from meeting many of our customers at the seminars, I can see the improvements many of those customers have made by actually starting to understand that, oh, finally, the market's been demystified. Tom Williams has told us that, yes, this is how it works. And now you've got the logic. The secret is to believe you can make money. Let me read you the document. It says why you can't win at trading, but 10% and 10% of retail traders do. We've just seen Tim Raymond win a major competition, a worldwide competition, with a 44% increase. And that's under a lot of pressure there, because you've got a lot of traders in China and all over the place in that competition. It says what sets the 90% apart from the 10%? Why is one person seemingly able to effortlessly take profits from the market almost on a daily basis, and yet another person trading the same market at the same time will be suffering consistent losses? Already, even at this stage, the 90% will be thinking that the 10% guys have better indicators or even a holy grail trading strategy. On close examination of the 10%, however, it will always, in capitals, be found that they often use the same software, the same data, the same indicators, and often trade at exactly the same time. If this is the case, and it is, then surely they must be gurus. They must have the Midas touch, the golden key. Well, sorry to deflate you, but once again, this is simply not true. The 10% group of consistent traders with many years' experience trading as part of huge organisations, and also the one-man woman in his or her home trading from a simple PC screen. In reality, they're a pretty ordinary lot. They do have one consistent common factor, however, which is usually revealed within 5 minutes of meeting them. They are also, more often than not, the most genuine of people who take a genuine interest in other traders. When one of the 90% meets one of the 10% for the very first time, the first thing that happens is that the 90% guy wants to find out every technical detail about every aspect of the 10% guy's trading, or girl's trading strategy, software, etc. In doing this, the real essence of why the 10% guy or girl is successful is almost always completely missed. This happens in much the same way as we miss huge parts of sales talks and yet we still buy the products. We almost always default to the comfort path of least resistance. Television advertisers have for years used these methods to make us buy products we don't want or need. They take the time to find out what we want to hear, that we want to be told. They discover if you like our comfort path and they sell to that path. This comfort path is the main reason why 90% of traders lose money. Just pause for a moment and ask yourself the following question, then consider your inner response, your inner voice that you pick up on. Do you think there is a mechanical, computerized guru system that will consistently give you profits? If you do, then ask yourself the following question. What would it mean if you had this tomorrow? Less stress, better health, zero emotions, self-esteem, more free time, power, more material goods. Now play with the thought for a moment, but really focus internally on how that would be good for you. After you do that, and take your own time to think about that question, you will have come a long way to discovering part of your comfort path. This is the path that you will evaluate any trading product on. This is how you will be sold the latest trading idea to come down the pipe. The 10% guy, on the other hand, does not have a comfort path for trading. He or she, and I keep saying that because obviously it's in the he here, but he or she has something far more reliable. Before we get to that, let's consider the points above and how these will affect your trading. Let's take less stress trading and see how you could satisfy this. How about the latest trading book, the latest software, a tell me what to do subscription, a guru's advice, a trading course to learn new skills, a gossip forum to pick up tips. Now look back at the list and notice that any one of them will help with the earlier blue text areas. So, the losing 90% are the traders who ultimately believe in the idea that there is an external product, system or concept that will satisfy what they listed under the bullet points that we listed above. The 10% have no such notion of the above. In fact, they will make money regardless. The 10% have one thing that every single one of the 90% is looking for. The 90% are not looking at the wrong product, the wrong system or the wrong concept. They are simply looking in the wrong place. It's all about what you believe to be true rather than what is true. What is a belief? What do you believe to be true? It might seem at first this is an easy question to answer. On the face of it, I suppose it is. However, once you start to question beliefs, things become not quite so easy to explain. We can say at a simple level that a belief is something you believe in. How do you measure a belief? Are there different qualities of beliefs? What will these beliefs mean to you? To gain a better understanding, you might try a simple exercise. Think of a belief that you hold to validate as being 100% true. You must start with the belief something like this. The centre of the sun is hot. Okay, now we must all believe that. Now is a time to think deeply about this belief. Best that you close your eyes, focus on the sun is really hot. As you focus on the belief, become extremely sensitive to how the belief feels. You need to do this with the utmost commitment, and this is why I'll send you this document so you can really do it, as I did, to really monitor how this belief is represented to the whole of your being. Now, we're not going to have time to sit here and do this exercise now, but I strongly urge you to do it. Next, think of another belief. As this is all about trading, we will use belief that you are a successful trader and you are making money. Again, I cannot stress enough at this point that you really need to do this with the utmost commitment to really monitoring how this belief is represented to the whole of your being. And again, you need to spend some time to do that. When you have completed steps 1 to 3, take both your beliefs and compare them against everything that you felt and experienced. If both beliefs compare the same, your belief that you're a successful trader produced the same experience that you felt with the belief that the centre of the sun is hot, then you probably are already one of the 10% who's making vast sums from trading. If you detect differences, you're almost certainly to be one of the 90%. Now, I'll send you this, the rest of this document goes on to talk about it, and it talks more about belief. But one of the things I've actually put at the top there, the reason I have belief is because of volume spread analysis. Because when I first got involved with Tom and all of this, as Tom was explaining to me that the markets, you know, were moved in this way, and then he said, yes, Gav, he said, well, let me show you, look, market, ultra high volume up bar here, that's a sign of weakness. And I'd say, right. See this low volume up bar here, that's a sign of weakness. And I said, well, you just contradicted yourself. I said, you just told me that high volume on an up bar is a sign of weakness. And the very next sentence, you then told me that low volume up bar is a sign of weakness. So I don't, you know, it can't be right. Tom, I talk about, you know, that particular concept on a chart, and yet it's one of the real reasons when we first talk in a seminar, people switch off because they think that's a contradiction. Why isn't it a contradiction?
Well, everything we say to you is built on simple logic. I mean, if for example you're at an auction, say, and they bring up an antique that you know is worth a couple of $100, but the enthusiasm of the auctioneer, he starts off at $1,000. You know perfectly well it's only worth $200. If we were charting your response, it would be very, very low, if not negative, because of your expertise on that item. If that was on the chart, you call that no demand. It's been marked up by the auctioneer, but you're not interested. So that's no demand. That's very, very logical. You see that all the time. But also, when you see genuine selling coming in, they mark the market up on some sort of good news. The professional money that's got holdings that they bought lower down will sell to the people rushing into the market their holdings. Every time buy order comes in, it's satisfied by a sell order. And that's why you get weakness on an up bar on very high volume.
So the herd are involved and the professionals are involved on the high volume, but the professionals are withdrawing their interest on a no demand bar because they know the weaknesses.
It's all built on just simple common sense logic.
And yet, ironically,
they mark the bar up in the cash market deliberately, and a few people fall for it. You'll get a few people falling for that up move, but the professional money certainly won't, and you'll see it's up on low volume.
Yeah. It makes perfect sense to me now after 7 years. Yeah. But no, I did struggle initially with that concept, and I know sometimes we're guilty of saying, well, it's very easy. But of course, some people out there grasping this for the first time, and a lot of people who buy this course will be looking at this and saying, okay, well, hold on a second, let me look at that. But how I proved it to myself was simply looking at the charts, Philip. Is that how you sort of grasp it?
Yes, I would say so. I mean, if you're looking at the high volume up bar, what you're getting there, as Tom said, you're getting the professionals selling to the herd. There's a distribution taking place from the strong holders to the weak holders. Mm-hmm. Now, when you go back into that area on no demand, so you have an up bar on no demand, what's happening is you've got no professional interest, but equally you've got no interest from the herd either, because their buying orders have already been met on the high volume before. So there's no further buying that's coming from the herd because they're not interested. They haven't got any money left to buy with.
Right.
So hence you get the low volume.
And then it falls. Yeah. Okay, let's go back. And Chris has said there's a book that he recommends, and that's great if you can share them if anyone's got any good books. I haven't heard of this book, but it's called With Winning in Mind by Lanny Basham, who's an Olympic target shooter, The Psychology of Winning. Always read books, ladies and gentlemen, they contain information. So that's looks like a good one. With Winning in Mind by Lanny Basham. And when we send our follow-up email out, we'll ensure that we include that, and I'll find the ISBN number. So thanks for that, Chris. So we've talked about belief briefly. Now, visualization, so important. What does that mean? It means looking at a chart and visualizing a winning trade. Now, I will tell this story. When I was in New York, this might sound odd, I knew what that trade setup would be before it happened. And I could almost, because before that New York Traders Expo challenge, I sat and visualised what I would do under certain circumstances. And I went through it in my mind, almost like a professional target shooter or an athlete. Any successful athlete will tell you that they play in their mind through and through what they want to see, so that when it comes and they're in that moment, they are in peak condition, peak psychology. And I believe trading is very much about being able to take your VSA principles that we're teaching you here, ingrain them in your mind, go back through this course more than once and visualize them, and visualize how you feel when you see it. Because I can tell you, when I took that trade in New York, I knew exactly what I was seeing. I was able to explain it, and I was able to take the trade with confidence, knowing that I was highly unlikely to lose any money in front of that very large audience. And I didn't know if that trade was going to come. I could have waited another 15 minutes and the whole competition would have been over. But if you listen to the recording, you'll hear me say when I entered, I think the other gentleman was speaking at the time, then I explained why I was in the trade, and then my only, if you like, going to review the trade, the only thing I may have done that I regretted was I came out a little early because I didn't follow Tom's simple trending system. But I only had 10 minutes left to go. But visualising winning trades means that when you see them and they appear on your screen, you know exactly how to react. Tom, you mentioned in your book about the army and how they train their soldiers consistently, the same, the SAS, which are the special forces here in England. And you know, when I was a policeman, you get trained. They don't just put you out in front of the criminal community and give you a truncheon, as they call it, or a stick, and expect you to go and do your job. You're formally trained. Soldiers train week in, week out for events that might never happen, like the Special Air Services, you know, the SAS. Now, you talk in your book about, well, to be a good trader, sometimes you have to train yourself. So that in the thick of the action, in the battle, when all the price movement's going, you're under control, you know what you're looking for. What's your view of that?
Well, I was trying to let people know that in the army they train these people up to cover a moment of stress. When you're crawling through barbed wire and there's people shooting at you, you have to be under stress. And the only way you can get through that is that you're so well trained that as a group you're going to win that battle. And that's what they teach you. But when you're trading, you're also under great stress because the way the market behaves, it seems to automatically want to mislead you. You get the gut feeling, which is automatically put there through all the various sources coming in, and inevitably that's going to mislead. So really you can't trust yourself. So you definitely need to be trained up.
Yeah. And so if I come on to point 3, I talk about being contrarian. Now, I can tell you that being a former police officer, to be contrarian was somewhat difficult. And when Tom told me what was going on in the markets, of course, initially, well, we know this. As soon as I get up and start talking about market manipulation, which is one of our websites, you see people leaving the room. They don't want to hear it. But it's interesting. Janet makes a comment here. She said, when it comes to understanding the markets, you have to understand the most basic point. I think it's like Tom says, we're not used to being lied to. We're professionals in our particular fields. And if someone puts out false information into my field of work, they will go out of business.
Yeah.
Being a contrarian has been one of the most difficult concepts to grasp. Once you do, it's easier to understand the markets.
That's very true.
It's very true, very true. Expert chart reading skills, I put, number 4. That's what you're here for. That's what we're here to teach you. We can't teach you to be contrarian. We can only show you the truth. And you're all here paying good money to hear the truth because you know we're telling you the truth. Human beings know when they're being told the truth, but the trouble with a lie is sometimes if it's so well broadcast on the news, you say, well, that cannot be a lie. They wouldn't do that. But of course, unfortunately, now we know the world is a strange place sometimes.
Well, occasionally they're not actually lying to you, but as we said yesterday, they're not telling you the full truth. We used that example of 9/11, when you saw the commentators on TV look very grim-faced, telling you that there was billions of dollars worth wiped off the stock market, lower prices were inevitable, and so on and so on. And but what they don't actually finish the story off, do they? They don't say, well, that's fine, that is the truth. However, don't worry, because we've got word from the New York Stock Exchange, which they must know about, or they should, the exchange should tell them, which they obviously don't, that all the dealers are busy buying everything they can get their hands on. That's going to make the market a strong market, not a weak market that all this terrible news is inferring. And that's more, they will put rumours out and they will lie to you in that way, but they don't tell you the full truth. Have you ever heard anything on TV saying, well, don't worry, they buy on down bars and sell on up bars?
Oh, you don't even talk about volume. I mean, you hear volume talked about on TVs, but they often see high volume and up bars, it's buying.
It's bullish,
I've seen that on several channels.
Well, that's typical. They say, well, it has to be buying because the high volume has to be buying because the market went up.
That's it.
That's the logic they see.
And that's why we have such difficulty sometimes in public events, because all the press and certainly on CNBC and that, you see them say that, and then there's this little pipsqueak from England sitting up there saying, well, that's selling, even though you proved to be right after the event, as with the oil market and JP Morgan.
They'll never understand.
No, it's an interesting concept, but people in this room and listening to this course will understand.
Yeah.
And there'll be one of a very small percentage of people worldwide, Tom, is that correct? We're getting there, but it's still an uphill struggle a bit because of we're up against the big media, and telling this story is almost like, hold on a second, you're saying something over here that doesn't make sense, because all the other people teach candlesticks and MACDs and moving average.
Right. Well, there has to be always a leap forward, and I think you'll find that over the years, TradeGuide is a next step up from all the MACDs and the moving averages and everything. I think you'll find that.
Yeah, well, Richard and I certainly hope so.
Well, I'm sure you do.
That would be nice, wouldn't it?
But I think you will find that.
Now we're going in the right direction. Now, I've also said here, expert chart reading skills, which is why you're here. Highly disciplined. I think that's, again, if the traders that I've met that lose money consistently, if they're being really honest with themselves, they have a slight lack of discipline, and it's nothing that we can train you to put right. Dr. Gary Dayton, our resident psychologist, is very good, but discipline is an individual thing. Everyone's different. I had to teach myself to not pull the trigger because I wanted to be in that market, and I've had to sit here and wait for my bus to arrive, and I've learned to do that. Spiritual. Now, why did I put that in? Well, in fact, all of the people I've met who are great traders are willing to help others and are spiritual in nature. Simple example of what the spiritual mean. It doesn't mean they necessarily are a Catholic or a Protestant or a Hindu. Nothing to do with that. I think it's even simpler than that. It's just being grateful. That's how I put it. Just being grateful. Now, what does that mean? Well, they're obviously got some sort of inner contentment that they have, or he or she has, and they're very, very often, 90% of the time, willing to help other people. Why do you think Philip's sitting here? And that's something that, you can't explain, but we all know there's something there. And I think of the good traders I've met, that's definitely there. I've said they're open-minded, okay, and willing to help others. Expect to receive. Now, that's an interesting thing. When you expect to receive something, the universe will give it if you ask for it in the right way. Well, trading's no different. You're expecting to receive a financial reward for what you've learned. Nothing wrong with expecting it, but if you don't believe you're going to get it, I guarantee you won't, which is why I put top of the list, belief. Excellent risk management strategies. Going to bring Philip on this one. Philip, why is that part so important, managing your risk? And we talk about taking a trade, but you saw me the other day cut a trade really quick because a principal came in. I didn't do it yesterday, I should have. But again, excellent risk management. Talk a little bit about that and why that's so important.
Well, before I got involved with investments, I actually learned accountancy. So I learnt numbers. So that's probably one of the reasons why I'm fairly good on money management side of it. But I've learnt that even if you're wrong most of the time, you can actually still make money. The whole point is to manage to cut your risk short if you're wrong and to get out very, very quickly. If you're right, the idea is to let your profits run. Mm-hmm. And if you can do that and get that right, you don't even have to be right for 50% of the time. You can still make money, and I know that there are people out there who do that. Mm-hmm. But the biggest problem is being right 75% of the time, and when you're wrong, you have big losses. Mm. Because that way you can actually still lose money.
Yep.
So it's all about risk and reward.
Yep. So Matt V's asking the question, if 90% of the volume is professional activity, there has to be a comparable amount of herd money to buy the professional selling. Do the naive individuals really have that kind of financial power? Well, let me just be clear here. When we talk about the herd, we don't just mean the individual person on the street. No. I saw a Goldman Sachs fund 2 years ago wiped out. We've seen Barings Bank. We've seen Nick Leeson, who traded on the wrong side with the bank. Please don't think that it's not. It's just the guy and the girl on the street that's doing this. No, these people are all trading against each other, aren't they, Tom? Yeah. And they'll use any advantage they can. For instance, now in the incident of Nick Leeson, where he lost a lot of money for the bank and the bank went out of business. That was serious money there that was being lost. It wasn't the herd there involved. He was a professional trader.
Yeah, he apparently went short, and when the market went against him, he made a fatal mistake of, like you would, getting out. He refused to get out, anticipating the market's going to turn and he's going to get his money back. That was the mistake he made.
So holding on to losers.
Yeah, not cutting his losses, and that's what happened with Nick Leeson. Okay,
and then. Risk management, we just talked about it briefly there with Philip. You know, there's good books on it. It's very, very important. Amazing. This would explain what happened to so many 401ks recently, said Matt. Quite, exactly my point. Always able to stay in the game. That means not blowing out your account, doesn't it? And not risking too much. I always say maximum 2.5% of your capital in any one position, Philip. Is that roughly right, or do you even do less than that?
Well, when I'm talking about it from an investment point of view, I usually reckon I wouldn't want more than probably 2% of my capital in one stock.
Right, that's about
maximum,
right.
Because that leaves me the option then of about 50 stocks in the portfolio.
Yeah.
Which I would say is about the maximum you can manage.
Yeah, and then take consistent and small profits. Now, you've seen me do that in the webinars over the last few months in the VSA Club. You've seen that we'll make losing trades, but we're always able to get back in the game, and that's a key part of it. You will make losing trades. Everybody does. I think even the top professionals make losing trades, but you've always got to have an account there. Don't blow accounts out, because you've got to go and get your hard-earned money and put it back into the market, and that's not the idea of the game. I've said take consistent and small profits, not greedy Alibaba. Well, I tell the story of Alibaba and the 40 thieves, and many know the story. Alibaba found a cave full of gold. But what he didn't do was suddenly load up all the gold onto his mules and go down the mountain with all this gold, because that would attract too much attention to himself. So what he did, each day he'd go up to the cave and take a little coin, put it in his pocket, walk down. No one noticed him at all, and over a course of a year he amassed 365 of these gold coins, and he bought a lovely house. Now, no one really questioned that, but his cousin Hassim decided that when he was told about this, Alibaba said, well, all you need to do, Hassim, is just take one coin every day and no one will notice you. Oh, no. He decided to get a load of mules up to the mountain, loaded them with gold. As he was coming down the mountain, there was gold spilling out the side there, and of course the 40 thieves saw this and said, thanks very much, killed him, and took all the gold. Well, that's how the market operates. If you just get in there, take a little and often, not too much, don't be greedy, don't overtrade, don't put big size on, just enough based on what your account size is, and take a little and often, it builds up, and then you'll be able to trade a bit more and a bit more size. Because a $5,000 account that turns into a $10,000 account, into a $25,000 account, into a $50,000 account, when you're trading a $50,000 account, 2.5% of your capital is much greater than a $5,000 account, so you can trade more size without too much risk.
And don't forget too also about compounding, because if you start with $100,000 and you buy some stocks, say you buy 20 stocks, and they all go up 10%, let's say, on average. You might have a couple of losers, but overall, on average, you get 10% return. Mm-hmm. Well, then the next year, say, you've got $22,000. Mm-hmm. Did I say 20,000 to start with?
Yeah, I think so, 22.
So you then have 22,000. Now, the next year, if you get the same return, you get the return on the 22,000. So to making 2,000, you make 2,200.
It compounds.
It may not sound much extra, but then the next year it compounds even more, and so on. Yeah. And you start finding that within 10 years you can be making $1 million.
Well, it's funny you say that, but there's a customer of ours who takes 2 points a day out of the S&P. That's his target. It makes a winning trade. It's 2 points. High probability trade, so that's 10 points a week. Started trading with one contract, went up to 2 contracts after a month, 3 contracts after 3 months, and now he's trading 10 contracts. He's only been doing this just over a year. And I won't mention the account size, but he's very consistent, and it's grown and grown and grown. So it can happen, but you've just got to be disciplined. Finally, I've put here, these traders that I've met are always happy and content.
We're happy, aren't we?
Well, I'm always happy and content. I mean, people listen sometimes, they say, why are you always happy? Well, that's half the battle, isn't it? We all have our challenges in life, but life is all about accepting a challenge and learning from it and saying, well, it's only a lesson. Yes. It's a lesson, and then we just move through and get to the next one. Sometimes that's easier said than done because there's some serious challenges we all have. But Philip, I mean, you and I are both the same. We really want to help other people, and as a result, I think both you and I, when we're working together, and Tom, you've lived a long old life, Tom, and you always seem very happy to me when I see you.
Yes. Yeah.
So, what did you do when you decided? I remember you saying to me, I said, why did you ever move from being a state registered nurse, which is what you were in England? What made you go to Beverly Hills? I always remember the answer. Do you remember what you said?
Yes, I do. I wanted to make money.
So I'm going to go where the money is.
So you go where the money is.
Yeah.
And in those days, the only place I knew was definitely money was Beverly Hills. It was very well known. That's where all the movie stars are and everything.
Yeah.
So I went there, and I soon found out that as a SRN in England, state registered nurse, I soon became a registered nurse in California. So then I joined an agency. I wasn't really keen on all this hospital, Dr. Kildare stuff. I joined an agency, and they send you out to private homes, private jobs around the Los Angeles area, looking after various people. Well, most of the jobs, of course, were in the moneyed areas. And one day the phone went. I picked the phone up, and the agency said, "We've got somebody here that's trading millions of dollars on the stock market." So that's fine. The trouble is, he's a drug addict, and the family are very worried, and they want somebody to keep an eye on him. So I was technically a minder, a medical minder, that is, and I worked with him. He took a liking to me, and that's how I got into it. He was in charge of one of these syndicates, and it was very interesting.
So like me, you didn't really intend to become a trader or a syndicate trader.
I fell into it.
I certainly didn't until I met you, that fateful day.
I didn't know anything about it.
Talk about a life-changing experience. Just one lunch with Tom Williams, and suddenly I'm carted off to Chicago. I'm married to two kids, and it's a strange life sometimes, isn't it? Yeah. But it's a good story. Anyway, question 7, and what we'll do, we'll answer this after the break. We're going to take a 10-minute break now, and then we're going to go into the final part of the session. So we've got about another hour and a half, maybe 2 hours, about an hour and a half to go, I think. John Shaler says, Onassis, the oil billionaire, once said on any deal, you can have the first 20% and the last 20% of the deal. Just leave me the 60% in the middle. I like that.
Well, do you know, I was remember a gentleman who was very experienced in the markets. He was a former stockbroker. I've probably told this story before, but he was very successful, and he was a multimillionaire. I'm going back 30 years or more. And he always taught me one thing: when you're investing or trading, whatever, always leave a bit for the next person. Don't take everything off the table. Leave just enough to tempt the next person to buy off you.
Interesting.
And that was good advice.
Very good advice, definitely.
And he was very much a person who would buy when all the news was bad and sell when the news was good.
There you go, you see. Okay. All right, look, the next question is, and I know this was coming, if you're a member of the VSA Club and you see our live trading sessions, you will have seen yesterday a nice losing trade as I tried to pick the top, with Tom smacking me round the head because I saw a perfect example of strength coming in, and I didn't close the position. And but nevertheless, the setup I was looking for, which I obviously talked about, was a setup several of you from the emails I've received traded and made some money on. So I'm going to explain what happened. And it says, please, Philip, Gavin and Tom, could you analyse yesterday's E-mini, S&P and NASDAQ in different time frames? I watched Gavin try to trade a top, and then he explained he was looking for a no-supply test in a rising market to go long. That is exactly what happened, but the market whipsawed for 4 hours before the move, which we know because we were trying to trade it. So how can we time our entries so we can catch the moves? Very good question. All right, everybody, we'll take a... Oh, Erica says she had a problem... with the she's in Spain, and unfortunately some bad weather out there. Compounding is the best, as Einstein said. I agreed. And Brad says, when do I start trading the World Cup Advisor? Brad, I have no idea. I've just only talked about it today, so it's just a thought and an idea. I'll discuss it with you next week because it'd be nice to have you in there as well. So literally just came up with the idea today, so hasn't even been discussed. but I think it's something that we should do, because people love to see some live trading. So that's where that came from.